This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Corporate governance. Corporate governance relates to how companies are directed and controlled. Now the essence of the problem arises because there is, in any company which gets really much beyond the family company, certainly any company which is likely to be quoted on any sort of stock exchange, the people who own the company, the shareholders, do not take any day-to-day management responsibility for the running of the company. The running of the company is something which is the responsibility of the directors. So we have this separation of ownership, the shareholders, and control, the directors. And this gives rise to what's called an agency problem or stewardship. Agency is where one party, the principal, essentially delegates power and responsibility to another party, the agents. So a travel agent, for example, you're the person who wants to travel, you go through an agent, and the agent is the person who is responsible for arranging your flights and your hotel, and so on. Shareholders are the owners of the company, and these people are called principals. The directors of the company are the agents. And it is a legal requirement that agents should act in the best interests of their principals. The directors should be acting to essentially maximize the wealth of the shareholders. However, because there was a separation of ownership and the running of the company, there is a danger that the directors do not act in the best interest of the shareholders, but that the directors act in their own best interests. For example, by awarding themselves very large salaries, by going into areas of operation which maybe personally interests them, but which is not necessarily likely to yield big profits. They can ensure they always get first-class travel and so on. They can engineer contracts which give them perhaps very large profit-related bonuses, where the bonus can be very large for a very small increase in profit. Of course, annually the company has to produce financial statements. These are audited, and the shareholders then, the principals of the duo, the shareholders then get an insight as to how the directors have got on in terms of managing the company. But of course that's annual, and sometimes if the accounts are postponed, it could be 15 months between one set of financial statements and another set of financial statements, and there's a huge amount of time in that where the directors could potentially be getting up to mischief. And this came to a kind of a head in the 2000s roughly. There were a number of big scandals. You may have heard of a scandal called a company called Enron. Enron was a huge company in America. And suddenly it went into liquidation. And it went into liquidation really because the directors were, anyway, doing their own thing, perhaps very risky activities. The directors were effectively bullying other members of the company. And they could really do what they want without any sort of inhibition or caution, perhaps, to ensure that the shareholders eventually did good. So after a number of these scandals, governments began to get involved and said this shouldn't happen. And governments brought in various schemes, depending on the country, to try and improve the management of the directors and the kind of monitoring of directors, if you like, to make sure that they were acting in the best interest of the company and its shareholders. The principles of corporate governance, these were set out really by the Organisation of Economic Cooperation Development, It is to facilitate the effective entrepreneurial and prudent management of the company to deliver long-term success. Now, within that kind of terminology, effective entrepreneurial and prudent management, there is a balance going on. The company will never make any money or any proper profits, really, if it doesn't take risks. If it doesn't take risks in maybe opening in another country or developing another product or taking over a company. And it's always recognized that risk is necessary to make profits. But then this is balanced by the prudent management of the company. The risks shouldn't be outrageous. And by that I mean the risks should be really what the shareholders are prepared to put up with and which the shareholders feel comfortable with. So some shareholders will be very, very kind of conservative. They won't want much risk. They will really be investing in companies which have got fairly stable earnings and so on. Maybe something like a supermarket. Shareholders who want their savings and investment to be subject to more risk, but perhaps subject to therefore greater profits, or of course greater losses, may be attracted to more entrepreneurial companies, perhaps something like pharmaceuticals, where an awful lot of money can be spent on research and development, and then 10 years into a project, at the very last test they do, they find some dreadful side effect coming from this pharmaceutical, and all of that money has to be written off. The principles of corporate governance divide into these 5 areas. It talks about the leadership of the company, and this will be kind of looking at what sort of caliber of directors you should have, how much time should they spend on the company's affairs, how often should they meet, should they be trained, and so on. Division of responsibilities is very important. This means that you should not have one director who has too much power. And in many of these scandals that happened in the 2000s, it was discovered that there was one person at the top, very charismatic, perhaps really a bullying character, who could just tell other people what to do, and nobody was prepared to challenge that director. Now it is pretty normal, pretty universal, that the CEO, the Chief Executive Officer, has to have responsibilities split from the Chairman. The CEO runs the company, the Chairman runs the board, and this split at the top means that one is kind of keeping the eye on the other. Composition of the board, succession and evaluation. It's important that directors' performance is evaluated. After all, nearly everybody else's performance in a company is subject to annual appraisal. Succession, how do we find new directors? Composition, very important in the UK. The composition is that you should have executive directors who run the company on a day-to-day basis, and you should have a roughly equal quantity of what are known as non-executive directors, people who have skills, but who, because they have no responsibility for running the company, they can kind of stand back, they can give unbiased, impartial advice, and they can issue warnings and so on, saying maybe, well, we think that project is a bit too risky, or this is not something that the shareholders will be happy with, or perhaps we think what you're proposing is maybe illegal. And in particular, they don't have quite the same profit motive. Non-executive directors' remuneration should not be linked to profit, so that they are not encouraged, if you like, to take decisions which are perhaps overly risky. There's audit, risk and internal control. It's important, if you're going to run a company properly, that you know what's going on. And an internal control system, how you authorize expenditure, how you record time, how you record costs, how you ensure you've got monthly management accounts, so you can keep an eye on how the company is going. It's important that this information system is in place, and that Internal control means it's reliable. Risk. How do we monitor risk? If we see a risk, should we do anything about it, or is it just a trivial risk? Or is it a risk that is maybe so serious you should stay right away from that project or right away from that country, because it is not something that the shareholders will be willing to shoulder? And audit. It's very important that auditors are sufficiently independent, are given sufficient cooperation, that they can fulfill their function, which is to examine the financial statements and hopefully to be able to conclude that the financial statements give a true and fair view. And finally, there's remuneration. How do we settle on fair remuneration of the directors in particular? Now, the principles of corporate governance, it was then up to every country to implement their own version or their own set of rules that should ensure that these principles were effected. In the UK, it is the UK Corporate Governance Code, and for ACCA exams you can use this as an example of best practice. So, just to reiterate some of the things we said, the division of responsibilities in the UK, a clear division between running the company and running the board, between running the board and what's called executive responsibility. No one person should have unfettered powers of decision. The board should be making the decisions, and not one individual person on the board. It should be a communal decision, if you like. And the CEO and the chairman's roles should be split. The chairman is responsible for running the board and should be renewed every 9 years. And non-executive directors must be appointed. And they are full voting directors. They don't have responsibility day to day for the company, but they could vote against decisions made by the board and argue very strongly against suggestions made by the rest of the board. The non-executive directors form really part or all of 3 board subcommittees. First of all, there is a nomination committee. And if you remember back to the principles of corporate governance, one was, how do we find new directors? And what you don't want is a director or the CEO saying, when one of his colleagues or her colleagues is leaving, and say, well, I have a friend, we play golf together, this person will be a jolly good director. And so you get directors appointed who maybe feel a kind of debt of gratitude to the CEO, and therefore they may not be suitable, but also they may be reluctant to disagree with anything the CEO says. How would you give employment to any person? Well, the way you give employment to any person is you want to find the best person, you advertise widely, you look at the applications, you narrow that down to people you're going to interview, then you make the offer to the best person. And essentially that's what should be done with new directors. But to ensure that the decisions are not biased, if you like, there was a nomination committee who was responsible for all of this director appointment, and the nomination committee is composed of non-executive directors. The remuneration committee, this is the committee which decides on directors' remunerations and bonus schemes and so on, that is purely consisting of non-executive directors. No director should be in any way responsible for deciding on or approving their own remuneration. So non-executive directors approve the remuneration of the executive directors. And then we had audit. Audit, where you have this external examination of financial statements, how we're going to find the auditor. What duties might we ask them to perform over and above their statutory duties? What happens if the auditor feels that they are being restricted in some way, and maybe the information they can receive or the explanations which they are receiving? Who's going to sort that out? What happens if the auditors discover that the system of internal control is very, very poor, and really the person who is kind of responsible for the system of internal control, strictly it's the board as a whole, but the particular board member who would be involved with the finance director, who liaises mostly with the finance director, it's going to be the auditors. So here, if the auditors who find problems with the internal control system, they report to the finance director, who is the person responsible for designing this faulty system anyway. Now what you have is an audit committee, again comprising non-executive directors, and the audit committee acts as the kind of liaison between the auditors and the company. Now, if a problem is found with the internal control system, or the auditors discover a fraud which could be deeply embarrassing to the finance director might try to kind of squash that information. The auditors report to the audit committee. These are directors who will also be appearing on the main board, and it gives much more strength really to the external auditors to be able to report to these independent non-executive directors making up the audit committee. Now, I said that the principles of corporate governance can be embodied in different ways in different countries. In the UK and most of Europe, it tends to be what's called a principles-based approach. You lay out broad rules about how companies should be managed, and then it's kind of left up to the company to try and comply with those rules the best it can. In the USA, it's very different. They have something called the Sarbanes-Oxley Act. It's what's called compliance-based. It's very, very detailed in the kind of steps and procedures a company must take. And really the directors have to sign off all of these undertakings. And often the external auditors have to sign off parts as well, really certifying that this very detailed approach to corporate governance has been followed. Principles-based tends to be a bit more flexible. Compliance-based tends to be inflexible, but you have perhaps better records, or maybe better assurance, not necessarily, but arguably better assurance, that the proper corporate governance steps have been followed. In the UK, the UK Corporate Governance Code has got no legal status. It is not law. Sarbanes-Oxley in America, it is law. But in the UK, it is listed companies who must comply with the Corporate Governance Code, and the body who gets involved if they don't is the stock exchange. Listed companies are expected to comply. The stock exchange will keep an eye on whether they seem to be complying. And if there is any non-compliance, the company must explain why they're not meeting that, and justify it. So you must comply or explain is the rule. So there may be a temporary situation where the chief executive officer and the chairperson are the same. So they could explain, say this is temporary because we're waiting for the new chairperson to be released from their present duties, and after 9 months the roles will be split again. And the flexibility of the principles-based approach would kind of allow them to, in a way, get away with that for a little while. But if that seemed to be the permanent situation, permanent flouting of the Corporate Governance Code, then as a last resort, the stock exchange can say, right, we're going to suspend your listing. You cannot have your shares bought or sold on the stock exchange anymore until you correct this problem you have with corporate governance. Corporate social responsibility. To what extent should the interest of stakeholders other than shareholders be taken into account? In many ways, the legal nicety says that companies should be run for the benefit of shareholders, but to what extent should we take into account the stakeholders like employees, stakeholders like customers, stakeholders like competitors even, stakeholders like the government? How can we extend, or should we indeed extend away from just looking after shareholders? It's difficult. Obviously good PR comes, good public relation comes, if a company can say, look, we've given money to charity, we have subsidized a local hospital, we are giving employees 1 day a week off to work for charity or whatever it's going to be. You get very good PR from that. But to what extent should a lot of money be spent by the company on, in a way, non-profit making pursuits, more charitable pursuits? And we have to be a little bit careful about it. First of all, profit is itself a good thing. Companies making profits give more stable employment. Companies making profits can afford to expand. Companies making profits can afford to do more research and development. Companies making profits will pay more corporation tax. And anything which maybe detracts from profits is maybe putting, shall we say, risk in the way of certain desirable outcomes. Secondly, instead of a company perhaps making donations to charities or doing good works, why don't shareholders do it themselves? Maybe give them bigger dividends, and if the shareholder wants to support a particular charity, then they can choose what it is and how much to give. If the company is supporting a charity, how do we decide which charities to give the money to? How much should be given? What is the authority to be giving to your favourite charity if you're a director, when if you didn't do that, really this is dividend going to companies, going to shareholders. So the decision about the beneficiaries is also slightly obscure. I think, this is corporate social responsibility is a very kind of common, I suppose, a very, very common thing for companies to be kind of proclaiming it and to be kind of shouting about it, to be proud of, and maybe rightly. But once it becomes more than good PR, then there are perhaps real difficulties in its legality in deciding the beneficiaries and giving money to a cause when maybe the appropriate person to be giving money to a cause is the government through corporation tax rather than companies themselves. Ethics, however, is vital. Good ethical behaviour is vital in a company. First of all, it reduces risk. If you behave unethically, be sure you'll be found out. And when you are found out, then there will be hell to pay. If you are discovered, for example, to have covered up unethical behaviour. And once one breach of ethics has been discovered, people say, well, what else have they been up to that's been covered up, and so on. So it reduces risk, and because risk is reduced, legal penalties are going to be less, and so on. And there, people will be willing to lend you money for less interest rates because you are a less risky company. Lower returns are required by shareholders because, again, you are a safer bet, a less risky companies. More collaboration with other good companies is likely. Why would a good company want to collaborate with a company which has had a history of bad events, bad ethics, unethical behaviour? you'll probably manage to recruit better employees. And the good name, the good will of the company, if you like, is likely to attract more sales. People would rather buy from an ethical company and be employed by an ethical company and collaborate with an ethical company than doing any of these things with a company which is regarded as being unethical, dishonest, unpleasant, not caring what harm maybe comes to their customers. Just very, very quickly, we'll look at what's meant by public interest. Companies may have to act in the public interest. And what we're looking at in the public interest, whether it's a company or a firm of accountants and so on here, is we should be trying to act in relation to all stakeholders. The public is all stakeholders. So if you're thinking of yourself as an auditor, you should be acting in the public interest. It's important to the public that you report fairly, or ensure the company reports fairly and truly on its financial statements. If you don't carry out an audit properly and inflated profits are reported, then bad decisions are going to be made. The information is unreliable. We don't know how to judge the performance of that company and so on. And if you cannot believe the information, financial information being reported by companies, there's going to be much less economic certainty. Is it a safe bet? Should I put my pension money in there? Are they actually going to be able to be sustainable employers for the next 5 years? To promote ethical behaviour, it's important for management to try to promote ethical behaviour. We need openness, trust and honesty. So if there's an ethical dilemma, for example, discuss it with someone. If you've made an ethical mistake, own up to it. Don't try to cover it up. That is not ethical behaviour of any sort. Show respect to the various stakeholders involved. So don't try to cheat customers. Don't try to cheat employees. Don't be unfair and bullying on employees and so on. Empower people to come forward to say, if they're worried about something, I do not think this is a proper way to proceed for this company. I've got some qualms about it that I'm not too happy about. And accountability. If you do something wrong, own up to it. Don't try to pass the buck to somebody else. Many companies nowadays issue corporate codes of ethics, and you'll see in the notes we have an excerpt there from Amazon's corporate code of ethics, stating out how you should treat suppliers, customers, government, competitors, stay away from bribes and so on, be honest and so on, to promote ethical behaviour, to reduce risk and to increase the likelihood that the sustainability of the business. So there we have a corporate code of ethics. It will cover things like equal opportunities, bullying, use of the internet during working time, bribery, money laundering, product safety recalls and so on. Don't wait till somebody out there is injured. If you discover that a product is unsafe, recall them. Every company makes errors, but the ones who get really hammered are the ones who try to cover up the errors and hope they go away. It's important that there's an emphasis on ethical value, and that from the very top, directors take this seriously, that they're not just paying lip service to it all. Sometimes there will be ethical conflict. An example of an ethical conflict is, should we close down this factory and move it somewhere else? And there may be very good reasons to move it somewhere else. Perhaps, where your factory is, houses have been built round it. It's very difficult to get to it by road transport and so on. Now a lot of congestion and so on. So I'm going to move it from the centre of the city. I'm going to move it somewhere else. And there could be very good reasons for doing that, but of course there's an ethical dimension to it, because the people employed in that factory may now be out of a job. And so there is an ethical kind of conflict. It's maybe going to be better for the long-term health of the company and maybe for the local population if we move the factory away, but it's going to be bad for the people employed in the factory because they're going to be losing their jobs. So what we need to look at here, we need to consider the facts. Who is going to be affected? What are the ethical principles involved? It's losing jobs, but it's maybe reducing pollution in that particular area. What are the fundamental principles? Are we being honest? Are we doing this? Can we at the bottom of it find a good ethical reason for doing it? What are the relevant internal procedures? And that might be asking for, do you want to move with the factory? Do we have volunteers for redundancy before we get on to compulsory redundancy and so on? Is there any way we can reduce the adverse effects on people? Consider alternative courses of action. So, one thing we could do with our employees if we're moving the factory is to say, right, we will give you lots of financial help to move. We will help you get your children into local schools if you move and so on. We will give you maybe additional training if you move and so on. So there are different courses of action. You have to think, do I need to move all of the factory or can I just move some of it? It's often not absolutely cut and dried what you have to do. And then you consider the consequences of each course of action. There'll be pros and cons, good aspects, bad aspects to it. You'll not necessarily get to an answer which is guaranteed to be perfectly correct. A lot of ethical dilemmas, there are arguments on a number of different sides. If you're unhappy with it, if you're happy with what's decided, let's say getting away from moving the factory, you think there's a product that's maybe got some safety aspects with it, and the kind of way that it's come down is that the company thinks, well, the safety risks are so small, we're not actually going to withdraw it there, and you remain unhappy with that. There's an ethical conflict. What you should do is raise the matter internally. Talk to people. How have you come to that conclusion and so on? Maybe escalate it a little bit within the organization. Take it to your boss's boss and so on. If you're really unhappy about some of that. What you can do then is raise it externally. So you can go and get professional advice, legal advice as to maybe what should be done. Professional bodies, ACCA for example, will offer advice on certain ethical conflicts and so on, as will legal advisors. In the UK there is now protection for whistleblowers, in other words reporting some problem publicly. And protection is there, if what you're reporting is a potential, for example, danger to the public, or if the company is breaking the law, then there's protection given, provided you do this for the proper reasons, if you do it in good faith. And if you remain very unhappy, then what you might have to do is to leave, to cease association with the matter or the company causing the problem. Now that can be easier said than done, because of course you will be leaving a company, you're leaving employment, you're leaving a regular salary, and we're talking here where you really can't live easily with your conscience. You may simply have to go.